If you owned your home here in Massachusetts for 10, 20, or 30 years, you're probably sitting on a substantial capital gain. Unfortunately, you may also be facing a huge tax surprise. I call that a high-class problem. Hi, I'm Matt Coyle, realtor and co-founder of Team Coyle at Compass. Today we're going to take a look at the math behind one of the biggest potential tax surprises facing local home sellers: capital gains tax. Let's look at a realistic local scenario. Assume John and Mary bought their Wellesley home 25 years ago for $600,000. Today, in our current market, they could sell that same home for $2.1 million. That's roughly a $1.5 million gain before exclusions or other adjustments. Now, because this is John and Mary's primary home and they are married filing jointly, let's assume they qualify for the federal home sale exclusion. This allows them to reduce their potential taxable gain by $500,000. But here is the surprise. Even after applying that $500,000 exclusion, they still have $1 million of potential taxable gain exposed to both federal capital gains and state tax. To be clear, this does not mean John and Mary owe $1 million in taxes. It means $1 million of their gain may still be potentially subject to tax. And keep in mind, paying off an existing mortgage at closing does not change this math. Your mortgage payoff affects your cash proceeds, but not your capital gain. So what else should John and Mary do? Well, they can start documenting two things. First, capital improvements and certain qualifying purchase costs that may increase their adjusted basis. Second, qualifying selling costs such as broker commissions that reduce the amount realized from the sale. Both can have a meaningful impact on your capital gain, but for simplicity's sake, we'll save that discussion for future videos. In today's example, however, the message should be clear. The home sale exclusion can be extremely valuable, reducing your potential tax exposure. But by itself, it may not be enough to eliminate it entirely. This is exactly why the tax conversation needs to happen before you list your home, not after you close. Start by contacting your CPA. Then begin putting together a paper trail, your original closing statement, renovation invoices, town permits, contractor receipts, and estimated seller closing costs. You'll want those documents in hand when you sit down with your CPA. And that's a wrap. Thanks for tuning in. If you like this video, please hit the like and subscribe buttons. I'm Matt Coyle. Have a great day.